This story, what Wesfarmers needs to do with Target, and obviously an extremely competitive part of the market, as Evan was just outlining.
When times are tough, I guess it's unfortunate, but companies do batten down the hatches, and in this case we are seeing job losses. So unfortunately for employees of Target, it does look like there's a lot of cost-cutting there involved. We know that it's a difficult market, and the warmer weather that we recently have seen has made it very hard, especially in that apparel retailing space. So it does look like Target cutting costs, and that's going to be a key. And then the market really wants to see its strategy take hold, and we need to see some more details and fleshing out of that strategy. But it does look like it's a difficult area in terms of that retailing space, and that not only impacts the retailers, the discretionary retailers, but it also impacts on shopping centres as well. So just watching that property space, as well as the property trusts which are exposed to shopping centres, to probably have a flow-on effect there. So we are seeing discretionary retailers as well as some of the property REITs being hit by the downgrades that we are seeing coming through, especially from that apparel and discretionary retailing space.
And Angel, the volatility then, what's the sort of thinking with that?
Friday we saw volatility across almost every single asset class overnight, and it was driven by the inaction that we saw by the Bank of Japan holding off on quantitative easing. And I guess traders just seeing an end to the central bank boosts that markets have had over the last few years. We have a look at the VIX index, the volatility index in the US. We saw a jump of 11%. In fact, if we have a look at the Dow Jones Industrial Average, we've seen swings of over 100 points in 6 out of the 7 sessions in June so far. So volatility certainly has spiked. Now, volatility is a trader's trend, so it's great news for traders and trading desks. However, not so good for investors. And I guess we're at an important juncture at the moment on the Aussie share market. Yesterday, we managed to bounce off the 200-day moving average, and the 200-day moving average is used by both traders and investors to determine longer-term trends. If we have a look at the 200-day moving average, it's quite interesting having a look over the last 10 years, and this is what it looks like. I've got the 200-day moving average in the yellow line, and just having a look at how it works and just having a look at a period of time, you can see that on the way up, that 200-day moving average acts as a floor for the market, so support for the market, and you can see the number of times we've actually managed a bounce off that before breaking that. On the downside, the 200-day moving average tends to act like a ceiling, so as resistance, and you can see we've seen a testing of that 200-day moving average. If I just zoom in now and have a look at where we are at the moment on the Aussie market, you can see we've seen a number of bounces, and at the moment we're testing that 200-day moving average line. It's at 4,744 points at the moment. It does look like a break of that. We really want to recover to above that line this week, and we don't want to see a long break below that line, because that would be a negative and that could trigger technical selling as well. So today we're watching that 200-day moving average on the Aussie market. Of course, the other big story is a slide that we've seen in the Aussie dollar, so we're watching stocks like Amcor, Brambles, Computershare, which will probably see a boost from that Aussie dollar today. But all up, it does look like it's going to be a pretty bad day on the Aussie market after we saw the US stock market losing about 1%.
Julia, just one more question for you too, and that's about an IPO that we saw yesterday. In fact, the first major IPO in years, Virtus, coming online yesterday. Is this start of a new trend? Are we going to see more IPOs in Australia now?
Well, this is a good sign, because this is the biggest IPO that we've seen in 2013 so far, and it did get off to a good debut. We saw an increase of 9% on the IPO price, and in fact the initial public offering was oversubscribed, and we did see the price that was determined as the initial price being at the upper end of the range. So all this bodes well. It is the IVF market that we're looking at. This particular company, Veritas Health, VRT is the stock code. It's responsible for probably about 1 in 3 IVF babies which are born in Australia, and this is quite a big market, a $500 million market here in Australia. So all up, a good debut. We'll be watching the share price action over the next few sessions to see whether we do see a stabilisation or whether the share price does continue to rise, and hopefully this is a good sign for that corporate IPO market in 2013, which has been pretty lackluster. Now, this particular IPO was a selling from a private equity company, Quadrant, so it is the biggest, I guess, the biggest IPO which is off the back of the selling from a private equity company from Myer, and of course Myer was a little bit of a disaster in terms of that. So it's good to see a good one in 2013, and hopefully it bodes well for the rest of the year.